what Roger's asking about is that he was recently in a bull put credit spread that was going against him. And he converted that into an Iron Condor. But he wants to know, how do you determine what strikes to use when opening the bear call spread? The easiest answer, which is probably not the right one, is to follow the same patterns, Roger, and the same approach you used for the bull put initially. What do I mean by that? Initially, I may have opened a bull put credit spread with at least an 80% probability that was 4 or 5% out of the money. Now I know it's come down and it's threatened my strike prices of the bull put. And we got to sell a bear call here now to make it worthwhile. I may consider looking for the bear call structure that's still 4 or 5% out of the money with an 80% probability, because if it bounces off of this low, news comes out soon about, the stimulus going forward to the Senate next week, and it actually goes positive and the market accepts it positively, we could see a pullback up. The rising tide will lift all boats, of course. So that's why I still want to leave some room. I don't want to go as close to at the money as possible. We're going to take RBA, and I'm going to put it in my portfolio as a bull put. And RBA is down to 54.30. What I'm going to say is that I sold the March while ago, 55 put, and this is a little in the money. Yours might have not gone this far, Roger, and that's perfectly fine. I usually would have preferred to adjust this position, of course, once it hit 1%. If it hit 55.60 or 55.50, I would have looked to do one of the 8 adjustments that we normally look to do. Let's say I open this 10 days ago. I don't even think RBA was above 55 then, but we'll take a look. And I did not get $1.40 for this 5-point spread. I probably got 65, 70 cents. So we're going to put in $1.30. All right. Whoop. That always helps, folks, doesn't it? Keep the math simple. Use one contract for a presentation. It's great. Okay. Now, I'm at a loss. I originally took in 70. It's going to cost me 173 to close this position, so I'm down 103. This is also there's 2 very important parts I completely left out on purpose, Roger, when I discussed looking for almost the same structure in the bear call that you initially opened the bull put in. And what is that? The 2 things I left out is, what is your loss right now? In other words, to repair this with an Iron Condor, I've got to find a net credit of at least $1.03. Otherwise, the repair might lessen the blow at this point. But unless it's more positive than 103, I can't get any positive return. I probably can't get that with the 80% probability position bear call remaining for March expiration. Another thing that affects this, of course, Roger, is time frame. Now, this is a position that's still 21 days out, so I have time to manage it. If I had opened one of my normal 2-week out bull put spreads that's shown on the weekly bull put default criteria search in the bull put credit spread search, and 6 market days have passed, I only have 3 days to go. I'm probably not going to be able to repair that with a bear call of any kind, because I'm only going to be getting 5 or 6 cents in net credit. It's not going to be worth it. But here we are with the bull put spread. Let's see if the position analysis does provide us with a bull put spread management techniques. Anytime you're tracking any position in the portfolio, we can go to position actions and then position analysis. This gives us a breakdown of our current position. I'm currently underwater on this trade. We know that, 103. And yeah, so it shows me some Condor opportunities. And it looks like these do have, it gave me the bear calls with a high probability. RBA is at 54.32. So it shows me here the 85 probability. I'm only getting 40 cents and 13 cents. So I'm down 103. We're only getting 28 credit back. Okay, I see why now. I'm going to have the programmer change this. This is inaccurate. Why am I saying it's inaccurate? These options up here, the 95 call, deep out of the money, of such a wide bid-ask spread, or it came through as an errant end-of-day data, Roger. I'll be honest with you. There's no way I'm getting 250 for the 95 call if I'm getting 40 for the 60 because it's the same expiration. And it has a BS ratio of 0. So I've got to change that. Let me do that. Credit spread repair, analysis, take out. Okay. Just a note for the programmer. Sorry, folks. There we go. So this Condor wouldn't work for me. Let's just simulate it to see what it looks like. So if it comes back up, in this case, and is trading between 55, where I get the 70 cents, and still below 60, we'd make a decent return of 98 cents as opposed to a profit of 70. That's true. But right now, Roger, it's still so far underwater, meaning it's below my short put strike price, that I need it to jump back up to get back to break even. And that's a little bit risky. This is a little bit risky adjustment. So the answer to, okay, I'm sorry. This would be the one that I would choose here because there's not that many strikes to choose from. But it is an 85% probability for the next 21 days based on what the stock has performed. Would I do the 55? Probably not. It would give me a better profit, Roger, in that case, going closer to at the money. But if I'm expecting any kind of rebound in this case, I'm not creating a condor, am I? With my example. No, I'm creating a butterfly. And butterflies are designed that you assume that you have to manage one leg or the other. Gives you a decent credit if it recovers. But now your upper and lower break-even is only 53 to 57. We're in the green zone now. It's not a bad play, but you have to be careful because either the short put or the short call is going to remain in the money at expiration. You're going to have to manage one of those legs one way or the other. The advantage of the Condor is that if it recovers as you expect and stays between the strikes, get a profit of $98 in that case. And both options would stay out of the money. You wouldn't have to worry about closing one or adjusting one. So, the general rule of thumb. When creating for the Condor, I typically want to keep almost the same sort of OTM or probability range that I would use to get into the initial position, 80 to 85%, 3 to 4% out of the money. But the net credit still has to meet or exceed what I'm currently losing in liquidation value of the position. Otherwise, it's not a real good repair, is it? And number 3, of course, is the fact that you could turn it into a butterfly using the same strike that we just showed here, which might give you a higher profit, but then you saw the tighter windows to break even. If you don't see a net credit for any of the new calls there that gets you back close to what you're losing now and still puts you in a safe range, you may want to consider doing another adjustment as opposed to using the Iron Condor to repair the bull put. What is another adjustment? Well, fun one I would try here, I would evaluate here on my position. Of course, any management, let me resubmit that. Any management you do, Roger, as you know, is predicated on the stock doing something next. Meaning that I need the stock to stay somewhere, move up somewhere, move down, and that's what we're looking for. One of our 8 ways that we look at to manage a bull put credit spread is called the pendulum adjustment. The stock has moved down against me. When would I use the pendulum adjustment? The stock has moved below my short put strike price, and my sentiment has changed, and I'm actually still bearish on the position. Rather liquidating this and taking the loss now, I'm going to see about selling to close my 50 put and buying a 60. So we're sort of taking the pendulum here and swinging it, and I'm going to create a bear put debit spread with one move for my existing bull put credit. This usually only works when the stock is trading between the strike prices. Usually the best time is right between the 2 strike prices. But with 21 days remaining, I want to see if it's possible to do a pendulum adjustment on this fake trade that we have. So what do I have to do? I'm going to convert a bull put to a bear put debit. We're going to sell to close our 50. we're going to buy a 60. So we're going to swing it around the pendulum. Not going to work. Yeah. When you do this, the total debit, new debit, has to be less than the difference in the strike prices. This is not one that would work. Actually, it's funny that if it falls farther, it will work. If it goes down to 53 or 52.50, the pendulum would work in this case. Doesn't have enough oomph on this long option to sell to close it to go back to the higher strike in this case. So, so close. We were 35 cents off. But again, one movement. If I'm still bearish on the position, swinging that out and creating the pendulum can get you back to a profit potentially on the bear put debit. What's the rub? Well, if the stock recovers, as you might have been expecting in this case, now you're at a loss where you would have been at a gain. So you do this when the stock breaches your short put strike price and you have a bearish sentiment on the position and you have 10 to 15 days still left to expiration. If you only have 2 days left to expiration, it's not worth it to try this position because everything's trading around intrinsic. You're not going to get the premium that you wanted for selling to close your existing long put in that case because you're too close to expiration. But to your question directly, converting it to an Iron Condor or potentially the butterfly is one of the 8 ways we discussed to repair that bull put credit spread. And I look for the strikes in this case to be relative to the same way I'd open the initial spread. Look for that same range out of the money and the same probability, dependent on the premium there as well, and dependent on other positions also. Okay. Right. Now, okay, so Roger, excellent. Roger says, thanks for the help. I like the approach of matching criteria when there is enough time to see more decent credit. Your goal is reducing the loss versus getting into a profit. Also glad to find some bugs. Great, excellent, Roger. And the one thing you've maybe heard me talk about before in this case, Roger, is, sorry, let's go here. Back to that free webinars and back to option strategies. I'm sure you've maybe come across it before, but we always point it out anyway. The full presentation on 8 ways to manage your bull put credit spreads, the ones we discussed there in that case. And in this presentation and follow-ups that we've done, you'll hear me mention that I'm hesitant to use the Iron Condor as a fix. And the reason why is if my sentiment has changed and the stock continues to go down, I've managed the loss but haven't changed the loss. I might consider another method if my sentiment has changed in that case.